Thank you.
Thank you. Can y'all hear me okay? I think, yeah, they got the little speaker thing on me, and they're recording me tonight, so everybody behave. This goes on YouTube, I think they said, and unless you do something exciting, we really don't want this to go viral, but it'll be available to you. I'm practicing CPA. I do tax returns for individuals and small businesses and some almost big businesses. And I've been doing that for over 30 years. It's what I like to do. I kind of wake up in the morning and I go out the door, and my wife looks at me and says, I'm going out to save the world, one tax return at a time. And that's, so I got to have a good attitude about it. No taxes are not always exciting to everyone, but I find them interesting. I find it interesting to work with the public. That's one of the things that I get to do in my job. And we at Dixon Hughes Goodman, we're a pretty large firm. We have over 30 offices throughout the Southeast, but we do feel it's good to get out into the community and to give back a little. Taxes have gotten more complicated over the years. Congress doesn't do much to really help us make it simple. Makes my job more important to people, I guess, but sometimes feel sorry, that they do make it so hard, but it is important. We have to do it annually, every year, and it's part of what we do. Before I start, tell you a little bit about myself. I again, been doing this over 30 years. I'm from this area. I did get some education up north for a while, but I grew up in Petersburg and I lived in the Richmond area. I was here at this hospital about 3 months ago, all-nighter with my daughter on our third grandchild. so that was a more exciting night than this, I would have to say. But it's good to be back here at Henrico Doctors. And if I can, I don't want to burden everybody with kind of saying who you are and where we are, but just got an idea of the crowd and what kind of things you'll have. How many people in here do their own tax returns? Okay, most of you. I kind of anticipated that. Rest of you go to like an H&R Block or a service or whatever. Okay. I don't have any IRS auditors in here tonight, do I? Okay, good. Just to make sure. I had one in my office this morning. I had an audit that we were finishing up, and actually it was medically. It was for a medical an agency that does help people with their medical problems, not Link, but it was another agency. So they do audit from time to time. How many of you are like self-employed? Is anyone here? Got one or two of you are self-employed. The taxes of the self-employed are a little bit different, a little bit more important, a little harder. I try to, again, if you want to ask questions in that area, I try to answer those questions a little bit more. Are any of you, I guess, how many of you are still employed right now? Retired, not retired, or whatever? About half of you, okay. And so, that kind of, everybody, those kind of questions vary and kind of give us an idea. Different people have different problems. I've done this for the last couple of years. We've spent a lot. What I try to do is just kind of give you an overview of things to look for to help save you money on your taxes. I don't really, I'm not here to tell you how to prepare your return. That's a little bit more complicated and probably something I can't really do in a 45 or 50 minutes. I will say, if you do prepare your return, there's plenty of excellent software out there, such as TurboTax and Tax Alert, Tax Cut, and things of that nature. They're very good. One of the things to remember, if you are doing that, one of the things TurboTax does is it does the same thing I just told you, just did with you. Kind of ask you a bunch of questions, get your background, what did you earn last year, how many dependents you have, and that sort of thing. And the problem you run in with TurboTax and people doing TurboTax is answer the questions honestly, because the program will lead you to the right answer if you answer it honestly. I mean, say, How many dependents do I have? Don't include your dog, okay? You know, I know you want to, and and then it's, so well, and then did you have any other income? Well, none that I count, okay? Things of that nature. So you have to kind of, be sure that you're really trying to be honest with yourself and honest with the program. Again, it was kind of interesting this morning. I was just, again, talking to an IRS auditor, and this was working with a nonprofit, but her previous task, her previous assignment, her job was sitting down with stacks of individual returns and going through and just looking at them and selecting the ones to be audited. Okay, think about that. And she said it was a very easy job. Amazing. Very easy, you would think. And why? She said, because people they put the weirdest things down on their tax returns. And so she was going through there, and it's like, whoa, okay, easy, this doesn't make any sense. This doesn't make any sense. This doesn't make any sense. So again, when you sit down and you do your taxes or prepare your taxes, or even sit down with someone helping you prepare your taxes, be honest, okay? Yeah, it's very... you certainly don't want to pay any more than you want, as H&R Block says, get your billions back. Okay, but you certainly don't want to pay any more than you have to. You want to take advantage of all your deductions, but if you start kind of, it's just like when you were lying to your mother, when you were little. When you start going off that deep end, you somewhat get there. So that's kind of my lecture, if I will. Okay, and I usually start off with some things about employment, but I'm going to kind of leave that toward the end and come back to it if we have to there. But because I want to kind of focus on the things that help you save money. Now, one of the things, and I think y'all had a seminar last month about the Affordable Care Act, and one of the things that is really different this year. Oh, and by the way, anybody has any questions, stop, ask, do the best I can to answer it. Tax code's only like 4,500 pages long, and I don't know it all, okay? But I'll do the best I can to answer it, okay? But one of the things we have this year is really kind of in coming 2013, 2014 is the Affordable Care Act, okay? And one of the things that is kind of different about the Affordable Care Act and things that deal with health insurance and medical coverage and so forth is much different than we had 4 or 5 years ago. And of course, the act was passed in 2010, and it's really starting to implement now. But one of the things that's really different about this is that the enforcement of this act is through your tax return, through the IRS, okay? And what it does is basically says, okay, everybody has to have coverage, whether you have it through your employer or through individuals. And you've seen a lot on the news in the last couple of days about the employer mandate being pushed back or whatever. But there's some things that came in last year, things coming this year. Of course, in 2014, we now have the individual mandate in full force. Okay, so some of the things that happened before, and this is what we talk about in employment, FSA, flexible spending accounts. If you're working and you have a job and your employer has what's called a flexible spending account, you want to take advantage of this, okay? That FSA. Anybody here know what? Anybody here using FSA? Okay, there you go. FSA, you put money aside and you have it available. Your employer puts it aside. When you spend money for your medical bills or whatever, you get to pull it back out and pays your bill. Now, why do you want to put it aside? You get to put it aside before tax, even before your Social Security taxes. Well, one of the things the Health Care Act is they limited how much you could put aside to $2,500. That was starting this past year. It used to be $5,000. Now, so they made it. Why did they do that? Well, it's a money raising. Again, IRS enforcement of the act is basically they said, okay, we're only going to let you put aside $2,500 tax-free, you can use that money. But if you do have those available, those flexible spending accounts, use them to the max. I used to be a controller for a business, manufacturing business, and one of my jobs was every year was going around, and I handled the health insurance for the company, and I'd go around, signing people up for the health insurance and the FSAs and so forth. And it was the darn gonest, hardest job to going around and talking to people and say, you need to put some money aside for your health bills. I'd have a guy, and his wife had many illnesses and whatever, and he was spending, several $100s a month just in his deductible for his prescriptions. And I said, here, put the money aside and you'll have it to spend. Well, I don't want to put it aside. Well, yes, you do, because it comes out much, much ahead. Okay. If some of you, one of the things they did in the Health Care Act is for small employers, they put a tax credit in there. We see that a lot. That doesn't really affect you much unless you are an employee. Anybody here an employer? So you said you were self-employed. Do you employ anybody? No, anybody? Okay. All right. So not there. But here's the big thing in red. Okay. Mandatory coverage began in 2014. If you do not have coverage through you personally do not have coverage, okay, you will be subject at the end of 2014 to an excise tax, okay? Not so bad this year. It's $95 per each adult in your family, $47.50 per child. So again, keep in mind, married filing jointly, two of you, both of you, almost $200. Have two more kids, that's another $100. That's a penalty. But keep in mind that penalty goes up a lot next year, and the year after, and the year after. And so the idea is, under the Act, they want everybody to have coverage. So if you don't have coverage, don't have coverage now, not so bad this year. Now, why don't you have coverage? Well, you didn't sign up for one of the health exchanges or whatever. I hate to get too personal with everybody, but anybody sign up for coverage with the health exchange you did? Okay. Got it done, right? Okay, they eventually got it done. Huh? Yeah, yeah. But they did get it. It took them a while. I kind of felt, sorry for the government in that, because it's a very tough, signing people up for health insurance is a tough task. And when you're out there trying to sign up millions of people at one time, it's very, very hard. And so it did take them a while to get it right. Those that signed up, people that couldn't get coverages before, people my age, they were paying a lot for health insurance. And I won't tell you how old I am, but anyway. but found that they got reasonably priced insurance on the exchange. Now keep in mind the exchange, what is an exchange? The exchange is a marketplace. In fact, a lot of the literature called it a marketplace. And it's still, you get coverage through a private insurer, and all it does is present one place where you get it. So again, if you didn't do it before and you don't have health insurance, 2014 is not going to be very expensive. 2015 it's going to get very expensive. And so you got to keep that in mind. So one of the things the government wants everybody on health insurance is so they spread the risk of the insurance, so that those people that on the exchange pay a little bit lower, seniors, those that couldn't get coverage before, they pay a little bit lower. Single people, young single people, they're probably going to pay a little bit more. Don't see too many young single folks in here tonight. Okay, but actually, they're the ones not signing up. Makes sense. The government really needs to solve that problem, and it's a tough deal. Also, to pay for the act, there's a higher, another tax, if you will, another layer of tax for those people making $250,000 and up. They're being asked to pay a little bit more, so the rest of people could have health insurance. So, not going to get into the politics of that, but that's where we are. Okay, so if your income is over $250,000, you are paying. 200 is single, 250 is joint.
Okay,
Yeah.
is it adjusted gross or?
It's a number that's close to adjusted gross. They call it modified adjusted gross income.
Okay.
But actually it's actually a pretty complex tax. It's two types of tax. One, if it's wages, you are paying over $200,000, you're paying an extra 0.9%. If it's what we call passive income, which would be interest income, dividends, rents, things of that nature, you're paying an extra 3.8%.
But it's still a 200,000.
Yeah, there you get there. Yep. So it's not. So for most of us, it doesn't really hit, but I do have quite a few clients that it does. Okay. Just kind of reminders, some other things that are still out there that do help us on the tax rates, and kind of get into where we are deductions in a minute. But some things to keep in mind that there was, I should have updated that slide. Okay, the 15%, if you do have dividend income or capital gains, a lot of times I get questions, people have sold a house or rental house they had or their parents' house or whatever, and I have capital gains. Keep in mind, capital gains aren't just stocks and bonds. They're any sort of sale of property you might own. Well, there is, on those capital gains, you pay a much lower rate, 15%. Again, if your income's high, it's still 20%, but it's a much lower rate of tax there. And if your income is below about $65,000, you pay a 0% rate on capital gains. Pretty neat. So that's to help people that basically maybe have a one-time gain from selling an asset or a house or something that they may have. Don't get confused. Sale of your house, though, your personal residence, is basically still tax-free up to $500,000. So, yeah, $250 for a single. Okay. So you're still there. Other things they extended, and these were kind of last year. One of the things in my profession, very good, they didn't change a lot of stuff this year. This is one of the first years they didn't really change anything for about 5. But so there's not a lot of new things here at the end of 2013. They finally, at the end of 2012, they kind of got tired of doing that again. But anyway, they have kind of permanently extended a lot of these credits now. Child and dependent care. Now keep in mind, dependent care is not just your child. It could be your adult dependent. Say if your mom or dad are living with you or whatever, and you have to pay for child care, not child care, but dependent care, that there's a credit out there, and this is available for everybody, up to 20% of $3,000, and for one child or dependent, $6,000 for 2 or more. Okay, so there's a full, not just for children, but it's also for your dependent parents. Another one people often don't see in this tax credit, this American Opportunity Tax Credit for college tuitions. And this is good for undergraduate college tuition. And it's good if your income level goes all the way up to $160,000, you still get the credit. And if your income level is not enough to use it, it's actually a refundable credit. So basically, it's your college tuition, books, and supplies. Okay, it doesn't include the living expenses, but it does include, and it's basically $2,400 credit per year. And if you don't have enough to use it all, up to $1,000 of it is refundable. So this is one, don't forget about that. So and it's good for you, your spouse, or your dependent, your children. And it doesn't matter if your child is not claiming it, you may claim it. So it's a really neat, it's a really nice credit. It saves a lot of money, helps pay those college tuition bills. That's what Congress wanted to do. Okay. still have a non-business energy credit through the end of 2013. So if you put some new windows in, put a new heat pump in or whatever last year, you still can get $500 back. Not a big deal. That expired actually end of 13. So if you did do any sort of window, any credits there, that's always good. And if your income levels, again, this is to encourage people to save money in their 401ks, IRAs, and such as that. So if your income level is low, but you should be saving a little bit of money away in your 401k or whatever, there's a saver's credit that you can get as well. And then also if your income $110,000 and you do have dependent children under the age of 17, I believe it is, there's a $1,000 child tax credit. It's still available. It's still out there. So a lot of good credits still available out there if you need any. Anybody have any questions on any of those? It's a saver's credit and I don't know the exact amount of the credit, but it's basically if your income is below $55,000 and you contribute money to an IRA or contribute to the company's, if you're working, company 401k or whatever, you get a credit, you get a tax credit based on how much your contribution is. So it helps you make that contribution.
Is that a refundable credit?
It's not a refundable credit. No, it's not. You've done some tax returns. Yeah, okay. Yeah, 94, okay, but that's her question was whether it was a refundable credit. Some credits are refundable, meaning that if you have more credits than you have taxes paid, you'll get the money back. There's very few like that. One I didn't put up there is an earned income tax credit, and it's still available, and they still are expanding it. Yeah, I'm sorry, you had a question back there. Yeah, same thing, yeah. Yeah. Yeah, so you have a, yes, you still have a, yeah.
On the child independent care.
Uh-huh.
We have a grandson that's in daycare.
Mm-hmm.
We're retired.
Okay. You have to be working you have to have earned income to get the credit.
Yeah, he's working.
Okay, he's working. Is the grandson a dependent?
Mm-hmm.
Yes, then you would qualify. Yeah. Mm-hmm. Yes. Yeah, if the grandson is a dependent, you would qualify for the child care credit. Okay. Mm-hmm. Okay. But the child lives in your house? Okay. He claimed, yeah. It comes back to a matter of who claims the child. Okay.
Could you summarize that for me? I couldn't get that.
Okay. If I could, your son lives with you and your granddaughter? And your grandson lives with you. Okay. All right. And so the question was whether, and do you pay the dependent care? You pay half of it. Yeah. In order for you to take the child care credit, the grandson would have to be your dependent. Okay. Now can the grandson be, I'm going to actually cover that a little bit more in a few minutes, but the grandson can be your dependent if your daughter doesn't take the grandson or your son-in-law doesn't take this grandson. So, okay. If you're providing over this, yeah, it's actually becomes down to a choice in your case because, right, so she has no income, the dependency deduction is not going to do her any good. And who is actually, it comes down to who is actually providing the support, okay? And if the child's living in your house and you're paying the daycare and you're feeding and your daughter has no real source of income, you don't have much difficulty proving that you provide over half support. So you could take the dependency, the dependent. might even be able to take your daughter as a dependent. So it depends on if she doesn't have any other source of income. Depends on whether she's getting child support, I guess. Yeah. But again, it comes down to how much. We're going to go over dependency. That's a huge issue, actually. We're going to go over that in a little bit more detail in a few minutes.
I have one more question.
Okay.
The non-business energy credit?
Yeah.
Does that only apply for your personal residence, or if you're putting things into rental properties, can you?
No, personal residence. Mm-hmm. Yep. Good question. Okay. Yeah. That's only. Yeah. You do not get it for rental properties. Yeah.
I didn't quite understand the first item of that, the 15% rate on corporate dividends and capital gains continued through 2012.
It's continued. It's actually now permanent. That's what. Okay. But
I'm sorry.
it's now permanent. It's
Permanent?
yes, ma'am.
And what was the rate of income that you said that you would not be taxed?
But if your income is about $65,000 or less, it's a 0% bracket for capital gains and dividends. So, pretty neat. It's a pretty neat deal. Yeah.
And that will continue on,
Yes, ma'am. Mm-hmm.
and there's no set date to stop it?
No, ma'am. They made it permanent at the end of 2012. Yeah. Mm-hmm. Okay. I thought, did I have another question somewhere? No? Okay, good. We're doing all right? Okay. I like questions.
You pay regular income tax on dividends and
No,
you don't pay it.
no, if your income's low enough. Yeah, yep. Okay. I always kind of throw this slide in there, and right now it's just to kind of some people sometimes ask me about estate taxes. They're worried about inheritances. Generally, inherited money is tax-free. If you receive an inheritance, you don't pay any taxes on it. The only tax that we have on inheritances in the U.S., and Virginia has none, is the estate tax, and that estate tax doesn't apply unless you've got an estate that's more than $5.25 million. They bumped that up back at the end of 2012, and it's actually per spouse. So if a couple they're now at about what, 10.5 million, and so if the estate is below 10.5 million, there is no estate tax anymore. Okay, so they said now that if it's over that, the estate tax is pretty high, but basically this has become a rich person's tax now. So and a lot of times people, I get a lot of calls from people with inheritance. Do I pay taxes on it? My aunt left me $10,000. It's tax-free. Okay. Now, put one little caveat on that. A lot of people, they'll say, my uncle left me his IRA. Okay. And that's a little different deal because kind of keep in mind, Uncle Joe had an IRA, and that was taxed. He put that money away before tax. And so when the money comes back out of his IRA, tax has to be paid. So if you inherit Uncle Joe's IRA, and when you take the money out, you're going to pay tax. So a lot of times people ask, well, how can I avoid that? You can roll it over to your own IRA. Anybody had that situation? I get that kind of call quite often. Okay, now we're going to get to the good stuff. What can I deduct on my return? Okay. Yeah. Generally, we're kind of going about what do I got to pay taxes on? Pretty much everything. Okay, income, but there are some exceptions. All right. Now we're at what can I deduct? Well, if you're a teacher, any teachers in here? Okay, one teacher. There's a you probably already know that, $250 above the line deduction. It's almost like automatic. All you get to deduct for your supplies and expenses for the classroom that you paid out of pocket. You are supposed to kind of keep a record of that. Okay, but it's a teacher deduction. Still there. It actually expired into 2013. You guys have got to get Congress to extend it. Okay. If you don't have a retirement plan at work, you can still do an IRA. You can do that up through April 15th, right? Yep, still do it. for last year. You get it. Now the neat thing, people ask me, why do I want to do an IRA? Well, you get a tax deduction for it. Okay, that's a 5,000. You don't have to do 5,000. You can do 1,000, whatever. But if you're in a 28% bracket, which is very middle income, and you put $1,000 into your IRA, you save $280 federal, $56 state. So $325 approximately, $330. So that $1,000 really only cost you $670. Again, has to be earned income. You do have to have earned income to do an IRA. So you do have, if you're retired, you can't do it anymore. Okay. People ask me about Roth accounts. Roth, you don't get a tax deduction. The money stays tax-free. I'm not a big fan of them for most people. It works for a lot of people, but I'm not a real big fan of Roths because you don't get an upfront tax deduction. But it works for you, but it does build money up for you tax-free. Again, the idea being you have a savings account, mutual fund account, whatever, and as a savings account, of course, none of them pay interest anymore, but they used to. But think about the days when they used to pay interest. They paid you interest, and you paid taxes on the interest. In a Roth account, you don't have to pay taxes on the interest. Mutual fund be dividends and things of that nature. Okay. Am I talking loud enough? You all okay back there? The speaker, okay. All right. All right. So those are some things you can think about that help you. Self-employed, I didn't put it up there. Self-employed get to deduct their health insurance up front, and we're going to talk about that. But very important. And again, self-employed person can put an IRA in as well. Okay. So what most people ask me about, what can I deduct on my return? Now, before we get too far there, that keep in mind that the IRS gives you a standard deduction. Okay? That if you're married, filing a joint return, your standard deduction is $12,200. Single, you get $6,100. That means the IRS gives you that as a deduction if you don't have enough of what we call itemized deductions. Okay? And so a lot of people say, well, I go out and I buy a house, I'm going to get mortgage interest, and we're going to talk about what more itemized deductions are. But when we go out there and say, well, I don't have, I'm going to buy a house, so I get all these extra deductions and give money to charities and so forth. Well, even if you had zero of that, you get to deduct $12,200. So it's an either or now. So people forget that if you're blind, over 65, you receive an extra kicker there, $1,200 for each of you, and over 65, $1,500 again if you're single. So again, nice deduction that works. You also get the personal exemption, which is $3,900 this year, for again for living and breathing. So keep in mind, here's your tax return. You make money, okay, you report all that. Then you deduct either your itemized deduction or your standard deduction, and then you deduct your personal exemption, and then what's left is what's called taxable income, and that's what you pay tax on. So the whole idea is try to get that taxable income down as low as possible. Okay, so this is how we're going to do it. Okay, itemized deductions. Again, standard is $12,200 for a joint return, but suppose you've got other deductions. You own a house, you get to take the mortgage interest. Okay, very important. Has to be your house. Okay, give you an example. Your daughter, if she were to pay your mortgage payment, okay, but it's your house, you wish, she wouldn't get the deduction, even though she paid the payment. because it has to be your house, okay? And so, yeah, so no incentive for her to pay it. Okay, now she can give you the money and you pay it, but, so, okay. And so, and also on a second home, you know, we have a lot of clients that have houses down in the Outer Banks and whatever. They do allow the mortgage interest for both your first and your second home. After that, no more than 2. You know, 3 homes, you only get to deduct 2. Okay, and so do have people do that. Okay, but basically, so you get, that's the biggest deduction most people go. Say, why don't I go out and buy a house? You go out and buy a house. Of course, you have the advantage of home ownership, but you also have the advantage of writing off the mortgage interest. Okay. Now, go out and you write the mortgage interest off. The mortgage interest is $6,000. How much was your standard deduction? 12. Okay. I'm not there yet. Okay. I haven't made any great money. People forget that. And one of the things also that people forget is that deductions cost you money. You have to pay for deductions. So if you get $10,000 worth of mortgage interest, that's a deduction on your return, but does the government give you back 10? No. They give you back your tax rate times 10. So again, average tax rate is 28%. So if you paid 10, you got $2,800 back. Okay. Use my IRA example. Not a bad deal because you put $5,000 in, you still own that $5,000, and the IRS gave you $560 back. Okay, is that right? I think more than that. But anyway, they gave you money back. Yeah, about $1,500 back. So, but you still own that IRA. Mortgage interest, you paid it to somebody else. Real estate taxes, deductible on your house, real estate, all the real estate taxes you pay. Personal property taxes you pay, deductible. How about sales taxes? Okay. Used to be people kept all their receipts and they had the sales tax. They changed that rule and basically said, okay, you can deduct either state income taxes or sales taxes. In Virginia, your state income tax is going to be higher. Okay. If you live in New Hampshire where they don't have a state income tax, your sales tax would be higher. Okay. So Florida doesn't have a state income tax. New Hampshire, Texas. Connecticut has a small one now. Yeah. Used not to, but they have one. Yeah. And not too high, but they still have one. Alaska doesn't. A few others, that's about it. Tennessee doesn't, although you have an income tax on interest. But anyway. All right, so and then charitable contributions. And here's, again, this is a big opportunity for a lot of people to save some money. Charitable contributions, basically your cash you give to charities, the money you put in the bucket at church every Sunday, keep a record of it, put an envelope, checks you wrote or whatever. Of course, all those are deductible, but they're non-cash items, okay? Non-cash. Okay, the stuff you go to Goodwill, you cleaned out your closet, the old furniture you took over there, all that is deductible as well. Now, you got to be careful about it again. You got to, Goodwill, when you go to Goodwill, if you ever looked at, they give you a little receipt. On the back of the receipt, they say, a used dress is average worth of $10 or something like that. And you need to kind of keep a record of what you give away and get it there. If you give away a lot of stuff over $5,000, you have to get an appraisal. There's also that, everybody's heard on the news, give your car, boat, whatever. Those organizations still out there. You can still do that. They'll come pick up your car and tow it. But they have to actually give you a receipt that says how much they were able to sell your car for you to deduct. It used to be they gave you Blue Book value, but they can't do that anymore. They cracked down on them. They said, because a lot of people had a car that wasn't running, and even though the Blue Book was at $1,500, car wasn't worth $20. And so they cracked down on it and said, okay, the organization now has to auction it, and tell you how much they auction it for. So that's what you get to deduct. All right. If the charitable gift is over $200, you need a receipt. The charity is actually, by law, supposed to give you one. Make sure you're giving to a charity that is what they call a 501c3, meaning a deductible charity. If you have any doubt, the IRS actually on their website has a link that you can look that up of all of them all over the country. And so political contributions are not deductible. Okay, again, be careful. Okay, so so it has again, but again the charity, if you give more than $200, they are supposed to give you a receipt. Another item comes up a lot. There is a charitable deduction of 14 cents a mile for any driving you do for charity. My wife does Meals on Wheels, for instance, okay, once a month. And so that's a charitable giving. We keep a record of it, add it up at the end of the year, how many miles she drives for Meals on Wheels, 14 cents a mile. Okay. Now it works for if you're driving the Little League team to Pennsylvania or whatever, you can deduct that. There are some limits to that. If you're going to the Rotary Convention, sorry, no, that doesn't work. Okay. There also, I have some clients that do mission trips, for instance, and into Africa and down into the Caribbean. Again, it has to be a true mission trip. They can't just be going on vacation, and they do. They're very giving folks. And they keep a record of their travel expenses and so on, and all that is deductible as a charitable contribution. Usually in the area I get some questions. Any questions on any of that? No? Okay. So keep in mind, these are what we call our reliable itemized deductions. Remember, taxable income. We're going to try to get taxable income down. What you want to try to do is say, is all of this more than my standard deduction? Okay? Is all of this more than my standard deduction? And for most people, if they own a house, it usually gets them there. Okay? And keep in mind, state income taxes, hey, not cheap. You know, you make $20,000, you probably paid over $1,000 in state income taxes. So this comes right off your W-2, how much you pay in the state of Virginia. State of Virginia, by the way, is one of the higher individual income tax rates in the country. Not the highest, but it's in the top bracket. But all right, why don't we... Okay. Other ones that people ask me about oftentimes, other itemized deductions, employee business expenses. Those are subject to what we call a 2% floor, and we'll kind of cover that. But basically, if you work out of your house, you have a job where you have to pay your own expenses, you can deduct that. Now, it has to be a job where you pay your own expenses. You can't deduct commuting to work, back and forth. Do you have to pay your own expenses? Probably. You're not, okay. All right. I was talking to you earlier. But anyway, so any of your jobs or whatever, mileage, business expense, and so on, you can deduct. Kind of interesting. Did anybody here have an office in home, work out of their home? Okay. Interesting. This year, it was way back, almost a year ago, it was late January, the IRS released a new rule effective for this year, and everybody forgot about it, was there's a standard deduction for a home office. If you took a home office deduction on your return, you had to keep your utility bills and figure out all your utility bills and prorate all your expenses by how much it was for your office and so forth. This year, they said, you can do it real easy. Just take how many square feet you're using for your office, take $5 times that square foot, and that's what your home office deduction is.
Can you choose, or do you have to use that?
You may choose.
So you can do actual.
Yeah, you can do that. Yeah.
And is that
doesn't matter, either one.
So if you do that one, it's 300 square feet.
Mm-hmm. 300 square feet, up to, basically, a maximum deduction of $1,500.
So your actual, if you're using more of your house than 300 square feet, might be more.
Might be more, but it basically gives you $1,500 to play with. Now, to keep in mind, not included in any of that is your home mortgage interest and your real estate taxes. You still get to deduct all of that on top of your $1,500.
Does that apply also to people who work outside of the office but do work at home?
Only if you're required to do that if you are required by your employer to maintain an office at home, okay, then yes. It's a good question because people say, yeah, I do work at home all the time, but it doesn't. You cannot take that home office deduction unless your employer requires you to do it. Okay.
You have to prove that, don't you?
You don't have to prove it on the tax return, but if you get audited, you have to prove it. Okay, and there are lots of cases where people have tried to prove it. Okay, and weren't able to. So yeah, so you got to be prepared to prove it. Yes.
Excuse me, so that if you're self-employed, isn't that requirement mandatory?
Yeah. Well, no, it's mandatory again if you get audited. You don't have to prove it on the return. Yeah.
I could just require myself to have a home office.
Oh, as far if you're self-employed. If you're self-employed, yeah, you have to. You're going to be required to prove it at some point. But yeah, self-employed does still fall in the same category. Do I have an office here, that I'm paying rent for over in this nice office park? If I do, then I don't need a home office. And so yeah, you're out of luck there. Yeah, but if I have an office, the classic case was the old country doctor. Okay. And whether the country doctor had maintained another office or he worked out of the back room of his house, okay, that was the classic home office, okay. But the country doctor said, okay, I got an office over here, but I come home at night and I use the dining room table for billing. That doesn't count. It's where he's seeing his patients. Okay. I just kind of put that up there. If your income is high enough, and that's basically, it's not all that high. If your income is basically about, for a single person, over $80,000, and for a married, not much higher, about $120,000. There's what's called an alternative minimum tax that says basically if these deductions are too high, we're going to tax you elsewhere. So those deductions being personal exemptions, in other words, if you have 6 or 7 kids, you may very well be subject to the alternative minimum tax. Not fair, but it's what it is. I've seen it happen. If you pay a lot of taxes, real estate taxes and state income taxes and what have you, you could be subject to that. So most people don't have to worry about it, but it's something to consider. All right. Now, we left off one very important itemized deduction, and that is the medical deduction. Now again, one of the things, remember I talked a little while ago about the Affordable Care Act, and that it changed some things. One of the things they did in the Affordable Care Act is they said, we're only going to let you deduct medical expenses if those expenses exceed 10% of your adjusted gross income. Adjusted gross income is basically your gross income minus a couple of things that are what we call above the line. But basically think about your W-2, your earnings from self-employment, whatever, that's basically going to become your adjusted gross income. You can deduct off of that your IRAs and what have you. But so you got to make a medical deduction to be available to you. Your medical expenses have to be more than 10% of your AGI. Yes, sir.
Does that mean you calculate your adjusted gross income before you calculate your medical expenses?
Yes, sir.
Okay, to carry on with that,
Mhm.
we have a daughter who had a catastrophic illness, an adult daughter,
Mhm.
last year.
Right.
Before she qualified for Medicare, we ended up paying big bucks.
Mm-hmm.
Can we deduct her
Yes.
expenses?
And I'm going to go through that in just a second, but it's a good question. A great question. And because that brings up my point. A lot of people look at this 10% adjusted gross and say, gee, that's a big number. Okay, let's say you make $50,000. That means 10% of that's $5,000. Okay, hard to get there. Okay, but here, let me tell you some stories, and let me tell you how it happens. You do get there. All of you, you're obviously in this group here. All of you probably have a lot of medical expenses. Okay. Of course, now what's happened with health insurance, all your deductibles, your co-pays, and so forth have gone up. A lot of you are paying your own health insurance. And I learned this kind of firsthand. I'll tell you kind of an interesting little story. It's a friend of mine, and we were having this conversation. You know, he would say, help me with my taxes. And my friend, he had a very high-powered job. He was making hundreds of thousands of dollars a year. And so first, again, think about hundreds of thousands of dollars a year, and 7.5, which used to be 7.5, now 10%. He said, well, I'll never get medical deductions up there. And what happened, he had an eye disease, and he lost his sight. So he had to retire. He's basically my age. This was a few years back, so younger than my age. Had to retire, had to give up his job. He went on disability. Fortunately, he had some pretty good disability coverage, but no longer making $100,000 a year. So, and he, again, he couldn't drive anymore, couldn't do his work, and he's on disability. So, once a month, I try at least once a month. We do more than that. Sometimes I go pick him up. I take him out to dinner, relieve his wife from having to deal with him for a night, and we go out and we go into the restaurant arm in arm because he can't see, get good looks, and I read the menu to him, but we have a good time. But he said, I'll never qualify for this medical deduction. Well, he said, one, you're not working anymore. Your income's not up to hundreds of thousands of dollars. Okay, what does that do? Drops this floor down. Second of all, you're not working anymore. Who's paying your health insurance? Well, I am. Health insurance is expensive. Okay? More expense. More, when you worked for an employer, they paid for your health insurance before, and you probably did it before tax. Okay? Now that you're not working, or now that you're on disability or whatever, you probably are paying your own health insurance, or even through the exchange, you're paying there. And then, of course, you got your co-pays and so forth. So that number doesn't look nearly as big, okay? So you can get there, okay? So your income's down, AGI is lower, you're paying your insurance, and again, you're paying for it not before tax, your employer's not helping you pay for it, and so you can get there. If you're over 65, this floor, this 10% is still 7.5%. They did put that into the Affordable Care Act. Okay, so you can get there. Now, let me tell you how else you can get there. Well, you need to look at all our medical expenses. Okay. Now, what is a medical expense? Definition right out of the code: diagnosis, cure, mitigation, or prevention of disease, or for the purpose of affecting the body's structure or structure. Okay, I put a list over here on the table, a little printout of what are medical expenses, what aren't medical expenses. It's back and front, 2 pages. Not everything in the world, but kind of something to help you go by. So be sure to pick up that on your way out if you want to. But basically, some of the things you know about: hospitals, doctors, drugs. Am I echoing back? Okay. Doctors, drugs, home health care, those things. Chiropractors, acupuncture, cosmetic surgery, unless it's medically necessary, is not covered. Here's one that I see from time to time: private school tuition. Okay, if it's a specialty school, huh? Autism is one exactly. It's a great example. Okay. For blind, autism, there's even ADD. I'm sorry. Even there's schools that specialize in ADD. So again, you have to get. But there are schools out there that basically say, yeah, our tuition, and it can be not all of it. It's basically the part that deals with the medical condition. You know, the part that deals with the, teaching the ABCs is not a medical deduction, but they say we do this extra for your child or whatever. It is deductible. Okay, so many things. Again, where it meets this definition. Capital improvements, what we call I'm an accountant, I know what a capital improvement is, okay? Maybe you don't, but a capital improvement is when, something we do structurally to our house, do a change in our house or whatever. Again, if the doctors, you have, the example here is emphysema. If someone has serious emphysema and they need special air conditioning equipment in their house or whatever, then that is an improvement that is a doctor recommended. A little tougher if you're going to put a swimming pool in the backyard and the doctor says you need to swim more. Okay?
I heard a large generator for the
Yeah, I've seen that. Yes. Okay, the generator. If I used to play, in fact, I used to play golf regularly with a gentleman, his wife, that he basically had to have his. She had some serious emphysema and whatever, and that he, he had to make sure the generator was easily running before he came to the golf course, or she could not go more than an hour or whatever. So yeah. So yeah, those sort of what we call capital improvements, if medically necessary, that will be deductible as medical expenses. So
also is long-term.
long-term health care, yep. Mm-hmm. Yep. We're going to get to that next slide. Qualified, we'll go back to the previous slide. Qualified long-term care services, okay, yes, are deductible. In the nursing homes, hospices, whatever. Now you have to be careful. Even the assisted living does qualify. And what you have to do is you have to get a cost of the care allocated by the facility, and they usually will issue a letter at the end of the year and say like 42.3% of your living expenses here were for medically necessary treatment. Most of the facilities will do that. So those are, again, keep in mind what we're trying to do to get above 10. How hard is it if you're in a nursing home? How hard is it to get above 10%? Not hard at all. Yeah. I mean, we're talking, cases $10,000, $20,000, $30,000 a month. Okay. Also, of course, your health insurance in general is deductible, but also your insurance, any insurance for medical care or qualified long-term care insurance contract. So if you're paying for a long-term care contract, that is a medical deduction. Okay? So, and if you're paying Medicare Part B and Part D from your Social Security, Part B or Part D, okay, that is a medical insurance deduction from your Social Security. Okay. If you're paying for Medicare extended coverage through a private insurer, that is medical insurance deductible. Let's see. Previous. Okay. Some of the other things, another biggie, in particular for cancer patients, because a lot of cancer patients end up traveling down to Durham or up to Charlottesville, and have a lot of transportation expenses. Your mileage is deductible at 24 cents a mile for 2013. Does drop by half a cent in 2014. Gas prices going down right now. They may adjust that back up. But anyway, the mileage, on top of that, You add any parking fees and tolls, okay, on top of the mileage, okay? So if you have to drive down to Durham, with Durham about 85 miles, then it's 170 round trip, deducted 24 cents a mile, adds up again. Any fees you pay for parking, whatever. Transportation cost of a family member, for instance, if you had to fly somewhere, if that family member is necessary to be there with you. I had a client that got some treatments in Houston. I think there's a big hospital down there. They had to fly down there. So basically, those are deductible, and if a family member has to be with the patient. Meals and lodging while en route, not deductible, but taxpayers warn cases where the trips were more than 3 hours. So basically, if I'm traveling across town and I stop at Burger King to buy lunch, that's not deductible. Yeah.
Someone told me that the mileage is only deductible from if you start from your house.
That's true.
That's true.
Yeah. What were you thinking maybe from your,
Well, because I always
Could you
went
repeat
from,
that?
okay,
Could you repeat the question, please?
I
Okay.
always went from work.
okay. Okay, is the mileage only deductible from your house? If you're traveling from work to your doctor, that's still deductible. The question was whether you could deduct the mileage only from your house. It's, from your house to work is considered a commuting expense, okay, which you can't deduct. I guess the question being if you live in the West End and you work downtown, and your doctor is back out in the West End, okay, can I deduct that? Is that your question?
Yeah.
Okay. The answer is going to be no, okay, in that case. Because now you're basically commuting from your house to work back to your house. But you can deduct, in that case, even though you're driving directly to the doctor, you can deduct the mileage from your house to the doctor's office. Okay. Yeah.
What happens if the person living with you is not a relative?
Mm-hmm.
Does it have to be a relative?
Oh, for the family member.
Uh-huh. Transportation cost of a family member, deductible.
Mm-hmm. Right.
It has to be a relative?
I think it does. You may have stumped me on that one, but I'm pretty sure it does have to be. Oh no, I'm sorry. It does not. I'm thinking back through it now. No, it does not. But it has to be your expense. You have to be paying for. Okay. Yeah. So it does not have to be a relative. But if you're paying for that companion, yes. Okay. Wow, that was a hard question. Yeah. Okay.
Quick question on meals. At least one day a week, my daughter has day-long appointments at MCV. And we generally have lunch together during the course of the day, not going to or coming from. Is that?
No. Yeah. No. Yeah. No. Not unless the only thing it would be, you could argue that your being there all day was required, and therefore, yeah. Okay. Well, if it is required, yeah, the answer could be yes. And you might be challenged on it, but I would, you'd be okay for the most part. That's another one. But yeah, if you're there, the question becomes if you're there to provide care, and it's necessary for you to provide care. Yeah, that becomes, in other words, it's something that the nurses, the other people in the hospital aren't going to do. Give you another situation, okay, that if my daughter's over here having a baby, and I'm over here all day. Well, like I said, I spent the night here waiting for her to deliver. So, I bought a couple of meals downstairs. That's not obviously deductible because, I was here by my own choice. Okay, and I was here to provide, help my wife and I were both here to provide her support, but we weren't required to be there.
Can I get a clarification just on the 24 cents bond? I understand if I take my wife to treatment back, 24 cents. If she's spending 30 days in treatment and I go down and see her every day, do I get to take that 24 cents a month? Okay. Thank you.
No, no, you get but you do go get the time you took her there, and then the time you came and picked her up, and did it for 30 days. Yeah, but not in between. That's a good question. Okay, yeah. Wow, y'all ask hard questions, but it does bring up. You know, it's not to say these areas are gray, but there's more things that you can deduct, and where you're going with it. So you know, just to kind of keep that in mind. Okay. All right. Oops. Okay. I'm going to come back to that. All right. A lot of you have asked questions about qualifying. What's qualifying? Whatever. Okay. Keep in mind medical expenses to pay for you, your spouse, and your dependent. Okay. First of all, they're deductible as long as you deduct them. A lot of times, again, you get the question, what is a dependent? I put that in here. And I could actually spend about an hour talking about what is a dependent, but we're not going to do that. But first of all, if a qualifying child is a dependent, bears a relationship, son, daughter, what have you, and they live with you. There are what's called multiple support agreements where in divorce situations where dad takes 1 year and mom takes the next year based on the agreement. There are forms that you have to fill out for that, just to keep in mind if you do know anybody that's got children, divorced parents. Under age 19, if they're a full-time student up to age 24, you provide over half support, and that child did not file a joint return. In other words, they weren't married and filed a joint return with someone else. That's what a qualifying child is. Now, you also can have a dependent that's a qualifying relative. Mom moved in with you, okay? Now, or dad, maybe you moved in with your kids, all right? That basically a qualifying relative spares your specified relationship. You're basically a relative, okay? Father, mom, father-in-law, daughter-in-law, aunt, uncle, so on. Pretty broad, okay? Okay, gross income less than, be a dependent of somebody else, your gross income has to be less than $3,900, and that person has to provide you over half support for them claim you as a dependent, and you do not qualify as being dependent on anybody else. In other words, you can only be one person's dependent, okay? You can't have more than one. All right, so that's what a dependent is. Now, keep in mind, they don't necessarily have to be your dependent. Pointing to you back there, don't have to be your dependent in order to pay for and deduct their medical expenses. And for medical deduction, we don't care whether they're a dependent of another person. So in other words, your daughter got married to a worthless guy, okay, that's not taking care of her. You're paying the medical expenses, but she's still filing a joint return with her, and so you can get that taken care of. Okay, and where a married person cannot file a joint. Okay, and then where a qualifying relative must, and then again, where you're helping somebody, you're helping son, daughter, or whatever, or helping mom or dad. Here's a big one, helping mom or dad. Okay, and your mom or dad has more than $3,900 worth of income, but you're helping pay the nursing home. Okay, you can get that medical deduction for the nursing home, even though mom or dad has some nice retirement income helping out. So, kind of going back to the previous slide, qualifying any expenses paid for these people, a qualifying child or Boy, I get under speaker there. Okay, qualifying child. Okay, we don't care if they file a joint return or if it's qualifying relative. We don't care if their income's too high or they qualify to be a qualifying child of somebody else. Okay, so we can get the medical deduction for all these people. Okay, if you're paying the medical bill. I had a, you know, again, here's the case. I had a case a couple years ago. Granddaughter had some drug issues. They wanted to send the child off to basically a drying out facility or whatever. And mom and dad didn't have the money to do it. Grandpa did. Grandpa paid for it. Grandpa gets the medical deduction even though the child is not his dependent. Come back here. All right, sorry. I want to talk for a minute, and I know there's a couple things in here in Virginia that I want to talk about, very important, okay? And then I'll let you go, okay? Long-term care premiums, if you do have a long-term care policy and you're paying those premiums, Virginia gives you a tax credit. A lot of people miss it. Virginia gives you a tax credit for the first 12 months of the premium, and then after that they give you a deduction for your long-term care premium even if you haven't deducted on your federal return. So, so basically very important, okay, that you get that on your Virginia return. Also very important, anybody here had to spend money in their home to fix up their home to make it handicap access, or build a ramp, widen doors, put in special bars in the bathroom, anything like that? See a couple of heads shaking. Virginia was willing to give you $5,000 to do that. It's called a livable home credit. It's a one-page application, has to be in by the end of this month, February 28th for last year. You don't have to send them any, all you have to do is add up what your bills were, put it on this form, put your name, address, social security number, mail it in. If they want to see your bills, they'll call you out. Yes, ma'am.
Is that for just 2013, or could we go back 2 or 3 years?
If I was told, somebody told me, there was a person from the state told me that there was money left over from 2012 and 11 and that they would process applications for that. What this is a pool of money the state has set aside. Yes, ma'am. State of Virginia. It doesn't go with your tax form. It's a little separate form. Huh. I don't know if North Carolina has anything similar. I have no idea. Okay, this is something Virginia has. It's called a livable home tax credit. Basically, what you do is you fill it in, but it has to be in by February 28th. Okay, you fill it in. They send you back a form. You may take a tax credit on your state return. You attach that letter with your return, and you get a much bigger refund on your state income tax. Okay, it's 50% of what you pay. So if you spent $10,000 improving your home, you get $5,000 back. You spend $5,000, you get $2,500 back. Really huge, really big, and I've got copies of the application here. Back of the application has the address. If you don't need it, you have a friend or whatever, the money goes unasked for every year. Other thing, both in Henrico County, City of Richmond, and Chesterfield all do is a real estate tax abatement. if you own your home and you pay real estate taxes, if you're over 65 or you're on disability, the counties, Chesterfield does it, Henrico does it, City of Richmond, they all have different limits. You apply. In Henrico, for instance, the maximum, if you make less than $67,000 in taxable income, your net worth is less than $350,000, which does not include your house.
Or the first 10 acres of land.
Okay, and that you can qualify for up to a $1,500 tax credit, or what they call abatement on your real estate taxes. Again, money in your pocket. All you just call up the county and ask them to apply.
Question on the livable home tax credit.
Mm-hmm.
Good friend of mine, because of his wife, had to have the bathroom handicap accessible. Starts it in August, but it's not finished until yesterday. Can he take it off in 13, or does he have to wait till 14?
Whatever he spent for 13, he can take off. Yeah, and he can get it for 14 later, for what he spent in 14. Yeah. All right, it's gotten kind of late. We've gone about an hour and 20 minutes. Any more questions? I kind of find once I go past an hour, people start dozing off. I'm glad to answer a couple of questions. Yeah.
I have a question. For 2014,
Uh-huh.
my family physician has gone over to a concierge service,
Uh-huh.
$1,600 a year.
Yes, ma'am.
Is that tax?
Absolutely. Okay, yeah. Mm-hmm.
Now, I paid the first part of 2014, but I paid it in 2013.
Mm-hmm. It's what year you pay it. It's what year that you pay it, you get the deduction. And it brings up a great point, okay? Again, going back to that 10% floor on medical. You get the medical deduction when you pay it. So what you try to do is group all your medical expenses into 1 year, if you can. So, the classic example is, a kid with braces, okay? I'm going to make a payment in December, I'm going to make a payment in January. Go ahead and make all the payments in December if I can. And the accounts, even on a credit card, counts as a payment. So if you don't have the cash and you can put it on the credit card, you can still get the deduction. But the idea, group all your deductions in 1 year. So that's a great question. One of my favorite points. Okay. Any more? Like I said, it's getting kind of late. I didn't want to keep y'all. I'm going to hang around for a while. I'm glad to. Again, I have a sheet over here. I think Denise said if you put your name, your email on here, they will email this information to you. And then I have a sheet over here about medical deductions. And also, if anybody's interested in the livable home tax credit, I have copies of applications over there. I also have my card over there if you'd like to call me. I've told Denise before, I'm happy to answer any questions people have or whatever. And I do not do free tax returns. There are services around. If your income is less than $50,000, the Internal Revenue Service runs a national program. They have local offices called VITA that basically will do your tax return for free. And they also have online services that will do it for free as well. So, all right. Any questions? Okay. Thank you very much.